Hello and welcome to a cmsfx daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, September 2nd, 2010. Let's start with the ECB interest rate decision, where the European Central Bank held its key lending rate unchanged at a record low of 1% as expected. ECB President Trichet said that the bank will continue offering a range of special liquidity measures to commercial banks, aka unlimited liquidity, into next year. Before today, policymakers had committed to lend banks unlimited cash at the benchmark rate until October 12th. However, this move was telegraphed earlier as German Bundesbank President Axel Weber, also a member of the ECB Council, said last month that the ECB was likely to wait until the first quarter of next year to discuss ending those measures. Therefore, the ECB will offer banks 3-month loans in October, November, and December, and the interest rate of those funds will be linked to the ECB's average benchmark rate over the maturity of the loans. With financial markets still fragile, there is no good reason to rock the boat, so the bank is playing it safe. Taking a look at the euro-dollar pair, there wasn't too much movement as the euro managed to hold most of its gains following yesterday's very strong session, though it paired about 1/3 of that if we look at the Fibonacci retracement from high to low of yesterday's swing. Now we saw the euro hitting a high during the ECB President Trichet's speech at 1.2850, but since then the dollar has gained on some positive US data. As we can see, we moved back within the upward sloping channel we had seen in last week's trading before we broke that support of that upward channel in this week's trading, so we could set up another parallel trend line, a new level of support. If we continue to head to the upside, the next level, as I mentioned several times in our past few videos, will be the 1.2920 area, our resistance level during this sideways channel we had seen in the middle of August. Taking a look at the euro-pound pair, we see that the euro extended its gains against the pound after testing the old resistance turn support at 0.8280. So we see that in overnight trading, and then we rallied during the European session. Zooming this pair out, we see now that we approach the 50% retracement of the full downswing we have had in this pair throughout the middle of July till the end of August, and we see that that is the level that we're currently trading at. If we take a look at this pair a little bit more in context now, we see that we had a pretty nice bottom to this downswing as we had this upward sloping level of support set up. And following that, we had a period of consolidation, and we broke that in this week's trading. We tested our horizontal level of resistance, which we broke, and now we retested that level of resistance as support. So very bullish signs for this pair. We'll see if we continue to see the euro gaining, as the pound was pressured today following yesterday's weaker UK manufacturing report with some weak data from housing and construction. Taking a look at those releases, we see that UK housing prices fell the most in 6 months in August, according to Nationwide, as we had an increased supply of properties which gave buyers more bargaining power. The average cost of a home dropped 0.9% from July, when they fell 0.5%, and you could see that on the chart to the right. From a year earlier, prices increased 3.9%, the weakest pace since November. In a second report, August construction PMI from the UK, a measure of construction activity, showed its third consecutive monthly decline as there was a marked slowdown seen in residential construction. The index fell to 52.1 compared to July's 54.1, and that figure came in below forecast. If we take a look at the pound dollar then, we see that in today's trading we saw the pound slide during the European session as its data came out, and it extended that decline during the New York trading, hitting a low of 1.5350. Now, we had mentioned yesterday the potential for the pound to slip as it had gained more generally as we had a burst of risk appetite as stocks around the globe rose on the first day of September. But overall, we did see weaker data yesterday from the UK, and with the follow-up of weaker data today, we see this decline. So we tested the 200 period moving average. We had mentioned that could act as resistance, and it did. So it's becoming a bit more obvious as data is showing a slowdown in the UK recovery, so that could pressure the pair against both the euro, as we are seeing, and against the dollar. Turning to the US, the number of Americans seeking jobless benefits fell by 6,000 to 472,000 in the week ending August 28th. It's a level that indicates the labor market has not improved this year even as the economy expanded. Employment is stagnating as businesses uncertain sales will hold up, delay adding workers. However, a second report from the US showed the strains firms may feel to start hiring as they are unable to continue squeezing productivity out of their current workforce. The labor productivity rate for the second quarter decreased 1.8%, a stronger contraction than the preliminary reading of a decline of 0.9%. Labor costs, meanwhile, rose by 1.1%, a sign that wages may be heading higher. We could see from the chart to the right of labor productivity that we had 5 quarters of strong productivity gains, and this is the first quarter where we see it dipping into negative territory. So while that may cause firms to have to begin to hire new staff, this won't be reflected in any positive way, likely in August's non-farm payroll report, where the economy is expected to show a loss of 100,000 jobs, though most of that will be temporary government workers that were hired for the census now being let go. Eyes instead will be on the change in private payrolls, and there's expectations of a gain of around 40,000. However, earlier this week, we did see the ADP report show a decline in private payrolls according to their measures, so we'll see if we see a weaker than expected reading from private payrolls in the non-farm payroll report. Now, there was some good news from the U.S. housing industry in today's data. Pending home sales index unexpectedly rose by 5.2% in July, when economists had expected it to drop by around 1.5%. Year over year, the pending sales index was 19.1% below the level of July of 2009. According to the National Association of Realtors, which puts out this release, home sales will remain soft in the months ahead, but improved affordability conditions should help with the housing recovery. Finally, in the US, we did see factory orders rise by 0.1% in July, and orders in June were revised higher to show a 0.6% drop, which was less than the previously reported 1.2% decline for the month. Economists expected a slightly larger increase for the headline figure for July. The increase was held back by a slump in orders for machinery, which slid 13.6% from June, and computers, which were down 18.2%. Excluding transportation, therefore, we actually saw a 1.5% decline in orders. Turning back to our highlights, let's take a look at the US dollar Canadian dollar, a currency pair most closely tied to risk sentiment, and we see that here too, similar to the euro dollar, we consolidated following the very big swing in favor of the Canadian dollar that we saw in yesterday's session. We set up near our level of support for this week at 1.0470. As you can see, we tagged that level before rebounding, so we were unable to push below Monday's low. So we have a very nice sideways movement now sideways channel setting up for this pair. U.S. stocks were slightly positive at the open following the pending home sales data, and oil prices, however, were down 0.6%, which could be pressuring the Canadian dollar here during the New York session. The Australian dollar-US dollar pair, meanwhile, after retracing a bit of its very strong gains in yesterday's session, we see it tested the 0.9050 level as support and is now rallying and is extending its rally in New York trading, so looking close to testing its highs from yesterday at 0.9110. While we did have some data overnight from Australia showing a weaker than expected trade balance report, which coincided with this slide in the pair, today's risk appetite perhaps in the New York session is helping it to power forward, as we are seeing some positive housing data from the US, which is helping this pair. This is also a bit of follow-through after we had a very strong rise yesterday following the Australian GDP report, and so we could see this pair continuing to extend its gains and targeting our highs that we had seen in this pair at 0.9220 earlier on in August. And finally, if we take a look at the dollar-yen, we see that the yen continued to gain during the Asian sessions, as it has done throughout several of the past few sessions. So we saw it test 0.8454, but then slide until it hit 83, and then slide until it touched just below the 84 level. However, as we can see, we stay confined within the range we've seen during the last few sessions, and we are coming, our 200 period moving average continues to move downward in this pair. So we're forming perhaps a bit of a triangle with support around 83.75 and this downward sloping level, which you can see as the moving average right now. Now, the U.S. did gain a little bit in New York trading following its pending home sales report, but overall we are seeing a sideways movement over the last 3 sessions in this pair. So we'll see how US stocks behave today, which could set the stage for how currency markets react, but for the most part, we may see timid moves until we get the non-farm payroll report in tomorrow's session. However, first up, in the fundamental docket for tonight, Australia will post its services PMI and Japan posts its capital spending figures. Overnight, Switzerland releases its measure of consumer prices, while the Eurozone will post its final version of its services PMI as well as a measure of retail sales. The UK, meanwhile, posts its services sector activity. Tomorrow in the US, we do get the big non-farm employment change report. As I mentioned, expectations are for about a 100,000 decrease. The unemployment rate, meanwhile, is expected to inch up to 9.6%. Average hourly earnings are expected to rise a little bit. And at 10 a.m., following the non-farm employment report, we get the ISM non-manufacturing index, which is expected to show a slight decline from its figures in July. And with that, I'll wrap up today's daily video recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.